Welcome. Today we're going to talk about flexible spending accounts through Better Business Planning's Benefit Administration Department. Flexible spending accounts allow you to use pre-tax dollars for eligible medical and dependent care expenses. They were actually created in 1978. Some people call them Section 125 plans, other people call them cafeteria plans, and you'll hear the acronym FSA a lot of times associated with them. Some of the eligible medical expenses that they're used for are deductibles, co-insurance, co-pays, ongoing therapy, and regular visits or exams to the doctor. People use it for dental expenses, very similar to medical, in that they use them for deductibles, co-insurance, co-payments, and orthodontia treatment. Another eligible expense is eye expenses. They let you use it for eye exams, eyeglasses, contact lenses, the solution, and even corrective eye surgery. Prescription expenses can be run through. Prescription drugs, the co-pays, contraceptives, or even elderly members of your family, the expenses for their prescription drugs. So can you run expenses through for your spouse or children? It is a plan available to everybody. It's for anybody that you claim as a dependent on your tax return, which is usually going to be yourself, your spouse, children, and again, maybe an elderly family member. Dependent care is a second account that's available to everybody. It allows you to run through the expenses for daycare for normal, healthy children ages 12 and under, special needs above age 12, could be for a spouse, and could be for an elderly member of your family. The expenses it's used for is the cost of a daycare center, services inside or outside your home, before or after school care, and nursery school expenses. So let's see how this actually works with a flexible savings account. I'm going to take an example of somebody earning $1,000 per paycheck. Subtract out what they actually take home from that paycheck and find out what they pay in taxes. What are the taxes? It's a federal tax you pay, Social Security, Medicare, and state tax. Could be anywhere from 25 to 49%. So if we take that total taxes paid, do a little division and then a multiplication, we find out that somebody earning $1,000 per paycheck is actually in about a 25% total tax bracket. So let's take a look at this on a per paycheck basis. Somebody earning $26,000 a year, not participating at the end of the year, they end up with $19,400. Let's say they participate for $500. In this example, they end up with $19,034. So let's look at that total. If we subtract those two numbers, we'll see the difference in take-home pay only went down by $368. Yet we do have a $500 account set up. So if we take that $500 account, subtract the $368 reduction in pay, end up with $131. That $131 represents the tax dollars you would have paid to the government. Add it to your reduction in pay, and you can see how you end up with a $500 flexible spending account. Daycare is very similar to that in that you'll have a $5,000 eligible amount that you could run up through to the account. So those that are in a 25% tax bracket, it creates almost a $1,300 a year savings. So instead of the daycare costing $5,000, it really brings your daycare cost down to about $3,700. Thanks for watching this video today. We know it's short, but so if you have any questions, feel free to reach out to us. We'd be happy to show you in detail how flexible savings accounts can work for you and your employees. Have a great day.